Welcome to LifeBlood. This is George G, and the time is right. Welcome to today's guest, strong and powerful Aaron Rubin. Aaron, are you ready to do this?
I'm ready to do this. George G, I like it. I'm in the Bay Area here, and we all had Jimmy G for a while, and ended up not doing as hot. So, but I know you're a better host than Jimmy G as a quarterback. So I think we're all right.
Jimmy G might be an amazing podcast host one day, and it's still a great quarterback. It just doesn't always work. So
yeah, well, that's true. Well, I'm a Bears fan, so Rex Grossman is really in our recent past. So
yeah, that's
great guy. We'll see how he does on another team.
I love it. Well, Aaron is a partner with WRP Wealth Management. They're providing successful Silicon Valley entrepreneurs with integrated financial planning, including pre-IPO planning. His first book is Financial Adulting, a guide for young professionals. Aaron, tell us a little bit about your personal life, some more about your work, and why you do what you do.
Sure. So my personal life. So I have three daughters, and so they're all under the age of 13. So I'm somewhat safe for now. Although my 12-year-old is sort of like a 17-year-old at this point, so it can get kind of rough. But that's sort of what my life revolves around right now. So it's either school or for them, or it's work for me. One of those two choices, and it's rewarding many a time and challenging even more. But in my professional life, I help individuals at pre-IPO companies make great decisions about their stock compensation. And so one of the things that sets us apart from many firms, one is that we have a tax firm in-house. So we prepare people's tax returns, we do projections for them, and all that important stuff that people need to do when they're going through major, we'll say, tax/economic changes in their life. And then you layer on top of that, we have this narrow focus on stock compensation. And so for people that are in that world, where they've joined a company that isn't public, and they've probably gotten a pretty decent amount of stock options, because that's how people get paid in Silicon Valley. They sort of get paid in the future, in some respect, because they can't cash in anything typically. There are exceptions, until much later on. And so those are the people that I help make decisions, and they're brilliant. Everyone I work with is super smart, and has a really interesting story, and they tend to be world changers, in the sense that they want to go out and make a difference. When they're a lot of times they're serial entrepreneurs, so they have a successful event, and then they're okay, what's next? And sometimes they're ready to hang up the spurs, and they say, well, I've made a ton of money, let's do some good in the world, and they want to do charitable planning and fund trusts and get their kids on their way. And so it's I have like the most fun job in the world, in my opinion, and got into it somewhat by accident. I was an accounting undergrad, and I ended up going to law school, where I met my wife. Now, my wife wasn't in law school. I would never marry a lawyer. I don't know who would marry a lawyer, but I certainly wouldn't. Don't know why my wife would. But she her dad was in this industry, my father-in-law, and so he was a pioneer in it, and said, hey, if you're interested, you have that right background, because he was also he's also a CPA, and I think you'd be good at it. I said, sure. All right, let's do it. And at that point I was in public accounting, and sitting behind a desk, in March, for 16 hours a day working on tax returns, wasn't as alluring as doing what he did, which was golf 3 days a week. So I said, that sounds like a really great idea. So that's how I got into it.
And here we are. I apologize. I didn't necessarily undersell you, but I certainly should have said that you are a CPA or had your CPA, and also a law degree as well as being a successful financial advisor. So love it. All right. So you're working with these super smart people. This is not something that they can figure out on their own?
A lot of times, sometimes they can. Most times they think they can. And at a certain point, the numbers get big enough that they're like, I really got to make sure that I'm understanding this correctly. And so that's when they'll come to our website, they'll read, we have a lot of information on our blogs about tax and stock options because that's our focus. And then eventually they'll reach out and say, hey, I have, X amount of shares. I want to exercise them. I don't have the money to exercise them. How does this tax thing work? How am I going to come up with the money for the tax? And so we can help them kind of piece together what they need to do to have not just a successful today, but a successful tomorrow, and get them to the point where, hey, yeah, when this whole event happens, I have a plan. I have an exit strategy. I have a tax mitigation strategy on the front end. I have a tax mitigation strategy on the back end. And so then, and they get to focus on what they do best, and that's engineering stuff and writing code and doing or managing people that write code. And again, and I think we bring a lot of value in that sense.
Yeah, that certainly makes a ton of sense. So it sounds like this probably makes sense to start engaging in this planning sooner rather than later.
Yeah, it usually does. And I think there's a couple ways to go about it. I think when you first join a company, especially if they're an early round company, A, B, even C round companies, typically they're going to be throwing a lot of equity compensation at you, and you may have choices right off the bat. So one of the choices that sometimes you have is something called early exercise. So when you get granted stock options, normally, they vest over a 4-year period. This is a general Silicon Valley thing. For the first year is a cliff vest, so you don't vest anything until you complete your first anniversary. Then you get 25%, and then the rest vests over, whether it's monthly or quarterly. And then from there on out, you sort of buy it or you can buy it as it comes along. If you're in a company that you feel super strongly about, sometimes what they'll let you do is they'll let you buy the stock option before it technically vests. And so, what happens is you have to come with the cash up front, to buy the stock option. So the stock option is a strike price, right? And that could be anywhere between, 10 cents to $10, depending, on where you're at. And of course the share quantity. And you have to pay that strike price up front. And the great thing about that is that you can tell the IRS, well, since I own this stock already, I want you to tax me on it before it technically vests. And the tax is the difference between that strike price and the fair market value, which when you first get your stock options, just so happens to be the strike price. So it's a zero tax game. And so then as the stock vests, you've already paid for it. You've already made this 83B election to the IRS. You don't get taxed on that difference, because if you would have waited, what would have happened is that delta between the strike price and the fair market value, that would have ended up on your tax returns somewhere. And you could have been hit, and when you bought the stock, you could have been hit by really high gains, whether and I don't want to get too much in the weeds, but those gains are calculated differently depending on the type of stock option it is. But again, if you can make that A through B election with early exercise, you can avoid a lot of that tax pain later on. And there's also some other benefits on top of it. So so again, the earlier it is, the earlier you have some really good early decisions, you got to think through them.
What is it? Is it 803? Is that what you said?
83B.
One more time.
83B.
83B.
Yep. 83B.
That sounds like a really big deal.
It's a huge deal, and it's interesting though. A lot of companies don't really think through it, and so a lot of companies don't actually offer early exercise. So if you're an entrepreneur listening to this podcast right now, do yourself and your employees a favor and have early exercise be a standard part of what you guys do. Because I see it a ton where someone's really excited about a company. So, well, it's great. You have these, whatever, 10,000, 100,000 shares, 10 cents a piece. Why don't do an early exercise? And they come back from HR and say, nah, I can't do it. And it's like, missed opportunity. But there's nothing you can do. Because again, unless you can buy them early, it doesn't do you any good.
And that's because when you actually set up your stock plan,
right,
you need to incorporate the ability to do the 83B.
Yep. Yep. That's right. So again, and usually when people are setting this stuff up, I mean, they got a business to run. They got things to do. They're not terribly worried about tax consequences that might happen 5 months from now, let alone 5 years from now. So but you got to be able to forward thinking on it.
This is I should know this, but I don't think that I do. Who actually what kind of entity is setting up these stock plans for companies?
Usually it's an attorney that'll come in and draft all the documents for the company. Again, if you're working with a corporate attorney, typically they'll try to do the soup to nuts thing. Hey, we'll set you up. We'll get everything started. And then includes the stock plan. So I just don't think it's on their radar necessarily. I mean, of course, now I don't set up these plans. Maybe there's a really great reason that I don't understand. But I know that there's some companies that do it and there's some companies that don't. And I haven't figured out the logic as to why that is. So I'm
Yeah,
assuming it's just because it's just people drafting that don't really understand the nuance.
got it. Could be. I wonder if there's other parts of society where there's people drafting things that don't really understand the nuance. Anyway, so life is challenging enough as it is. You've got 3 daughters under the age of 13, and when things are going great, it's still tough. And we're running businesses and everything else. And then the stock market explodes. How are you talking to clients and people about managing through uncertainty or whatever the term might be?
Yeah, so I'm going to say I'm super excited. I think this is fantastic opportunity. I don't know what this bear market. I don't think it's technically a recession yet. I don't know what this bear market is yet. How long it's going to go, but relative to where it was, almost to when the COVID hit, right? It's on sale. So there's opportunities to buy out there, even if you're just buying the broad market, which is what we tend to do. And certainly you've seen the public markets tank, and of course there's tax loss harvesting you can do. You can grab some tax assets on your income tax. And then that what people need to know is that the public market looks ugly, right? It's down 30%. In let's say the Nasdaq. I haven't looked at my phone yet this morning. Our market's just opened not that long ago. But if what you see the market is doing that, you can bet under the water, right? That's the pre-IPO world. It's just as turbulent, if not more so. So coming up in the next few months, if things stay status quo, and I've seen nothing to indicate that inflation is abating anytime soon, or the Fed's saying they're going to be more aggressive yesterday. The valuations for these pre-IPO companies are going to tank, and that's good and bad. It's bad for the company because now it's hard to do a capital raise and you don't get as much money, when you do that. But for the employees, the stock price that 409A valuation, that's coming down, and that's opportunity. And so it used to, maybe a few months ago, you did the calculation that was like, oh, geez, I have to come up with, $20,000 to buy the stock. Oh, and by the way, I also have to come up with, $500,000 to pay the tax, which is not unusual. Now you can look at it and say, wait a second, I still got to come up with the 20,000 to buy it, but now my tax is like 100,000, 150,000, maybe less, depending on what it is. And so if you're still confident in that company and you see this massive valuation, decrease, that's great. That's fantastic for you. Now, if you don't believe in the company and you think they got exposed and you think that, it's still a bad investment, right? The stock options, at the end of the day, their investment in a company. It's a good value as long as the company, has liquidity. But, again, you are investing. And so you just got to keep that in mind.
Makes a ton of sense. Thank you for that. Well, Aaron, the people are ready for your difference-making tip, even though you've given us a bunch. What do you have for them?
I think my difference-making tip is always do your tax planning. It's you can do some back of the envelope type stuff. If you're a non-tax person, you're going to go online and get these calculators, but at some point you really need to engage someone about that. Whether you're selling, a rental property or, because for instance, for that, Obviously rental properties are now all the rage. You go to sell rental property, you've had it for 5 years, and you say, okay, well, I bought it for this, I'm gonna sell it for this. My tax rate is this. Great, I know my taxes. Well, no, you don't, because you need to realize that on your tax return, there's something called depreciation recapture. And there's all these nuances that get baked into it. And the same thing goes for stock options. When you buy your stock options, you get taxed. Now, when you sell, you get taxed too. You get taxed at both ends. But when you buy your stock options, depending on what happened during the year, you could be facing taxes that you didn't know you had. So I've had that conversation with people before. People who called me up again, they realized the numbers got big enough, and hey, yeah, I exercised. It was just 5,000 shares of blah blah. And I said, well, do you know that's a $250,000 paper gain? And I mean, and you realize that's going to cost you like $20,000 in taxes. What? So it's like you have to, when you have an event, when you sell a property, when you buy stock options, you got to be thinking, okay, let's pay an expert who really understands this stuff to do this work. For like my firm, just for instance, my firm charges about $300 an hour. If we're doing a tax projection, on a short-term basis, we're 2 hours of work, maybe, depending on how complex it is. Spend $600. Be certain. Don't cheap out on it, because man, if you show up on that tax bill and you're underpaid by however much, hundreds of thousands of dollars, maybe it's only 50. There's penalties if you don't pay on time, and that may exceed $600. So it may be worth your while.
Well, I think that is great stuff. That definitely gets come on. Ounce of prevention is worth a pound of cure, kind of a thing, Aaron.
Yeah.
Love it.
Yeah, I mean, of course, and sometimes there's things you can do about it. Sometimes you just got to take the medicine.
Yeah.
Sometimes there's nothing to do.
Love it. Well, Aaron, thank you so much for coming on. Where can people learn more about you? How can they engage with you?
Yeah, so our website's a great place to start. WRPwealth.com. Mentioned some blogs there. Again, it's hyper focused on that pre-IPO world. And I think we're going to start coming out with more articles on acquisition. I think that'll be coming up a lot more as valuations come down. Larger companies with tons of cash, Apple, Google, all those places, they're probably going to be looking to buy. So I think we're going to see some more M&A coming up with all that cash sitting around. And then so you can check out our blogs that way, and then you can always schedule a consultation. We don't charge for the first couple of meetings, just to get to know you. And then of course you can head off to Twitter, WRP Advisory, or Facebook, which is, again, we post our blogs there as well.
Excellent. Well, if you enjoyed this as much as I did, show Aaron your appreciation and share today's show with a friend who also appreciates good ideas. Go to WRPwealth.com and check out all the great resources, read the articles, and figure out if now is the time. And it's probably the time if you are thinking about it, because to Aaron's point, the cost of being proactive is probably going to be a lot less than the cost of being reactive. And then find him on Twitter and Facebook as well. Thanks again, Aaron.
Thank you.
And until next time, keep fighting the good fight. We are all in this together.